This roadshow is brought to you by ResearchBytes.com.
You all to the annual analyst meet being organized by PTC India Financial Services to discuss the quarterly results and the Q4 and the annual results. So Mr. Deepak Amitabh, chairman, is unfortunately not here. He had some health related concerns, so he was not in a position to travel. Dr. Ashok Haldia, MD and CEO, and Dr. Pawan Singh, Director of Finance and CFO, they're here with us and they'll take us through the analyst meet and the presentation. I hand over the mic to Dr. Ashok Haldia, MD and CEO of PTC India Financial Services.
Good evening, ladies and gentlemen. It's indeed a great pleasure for me to welcome you all on the analysts meet and to take you through the yearly results for the financial year 2015 and 16, and also the quarterly full results for this financial year. I will divide my brief presentation in two parts. One is what's going on in the power sector, and the another in terms of the performance of the PFS. But before that, I'm to inform that Mr. Deepak Amitabh, the chairman of the company, couldn't come because he had some cervical related issues, and he had asked me to communicate that possibly for the first time he's missing the analysts meet. But next time he would certainly be with us. We are seeing power sector in transition. We are seeing power sector in turbulence. And for some of us, power sector in turbulence as well as in transition. If we recall the history of the power sector in India, the turbulence in the power sector is not a new thing. What is normal for the rest of the industry is abnormal for the power sector, and what is abnormal for the rest of industry is normal for the power sector. Be its demand, be it supply, be it a coal supply, be it operational or financial efficiency, be it tariff. If we track the history of the power sector for last 50, 60 years, we'll find all these problems. And often at all times we said, these are the problems which are unsurmountable and power sector is going to do. But power sector has survived, power sector has thrived. It's a public utility, and therefore it's bound to receive the attention of the government, the regulator, and the other stakeholders. During the year, we have seen some of the important initiatives in the power sector, and first and foremost, which is the concern of all of us, is the counterparty risk, that is the state of health of the DISCOMs. We have reached the DISCOM's financial condition was in a precarious situation. We have seen emergence of the UDAY after the FRP of 2002 and 2012. In 2015, we have seen the UDAY. There are debates and discussions as to what the UDAY means to the state DISCOMs and what does the UDAY means to the generators and the other stakeholders. But to us and to me, one thing is quite certain, that the UDAY of 2015 is different than the FRP of 2002 and 2012 in many respects. If you are looking at UDAY in terms of the 100% results as it envisages, then possibly we are going to have disappointment. But if we are going, if we hope that the reforms sought to be asserted through the UDAY would move in the right direction and would move in the right direction to a great extent, then maybe our expectations would be fulfilled. For the simple reason that the UDAY means that the DISCOM's losses would have to be part of the state government's fiscal deficit. That being the case, no state government would like that its borrowing power gets reduced because of the borrowings or the losses of the state governments. The another thing that has taken place is the changes in the tariff policy. Tariff policy tries to reform and rationalize the tariff setting pattern in the country, the role of the regulators, and also how the cost of generators and transmission and distribution should be passed on to the consumers. The third thing that we have seen is in terms of the availability of the fuel. Not only the coal availability has increased, but also the rationalization of the coal policy in terms of the location of the plant vis-a-vis the linkage to the mines from which the coals are to be allocated. The recent decision that the plants which are going to be commissioned in 2015 and 16 would be allowed the coal linkages, and also the another decision, cabinet decision of the government, which I believe is in the pipeline, is that the coal power, that the thermal power project of more than 25 years old, which in aggregates amount to 26,000 megawatt capacity, would be gradually phased out and would be replaced by supercritical technology plants. So that would save a lot, that would bring a lot of efficiencies, and would in turn would mean a lot of saving in the fuel consumptions. We have also seen, expecting the changes in the law in terms of the Electricity Act, the separation of carrier and the content, the reforms in the tariff setting, and also making the open access a reality. When I'm saying a reality, it might sound strange, but that's a step forward towards making the open access a reality. We have also seen the thrust of the central government and various state governments on the renewables, 175 gigawatts of the renewable power, solar, the wind, and the biomass, and the others. When it was set up, when these targets were set up in 2013, everyone, most of us, was thought of laughing it away, but that seems to be a reality now. There were myths around the solar power, and these are not unique to India. Globally, there have been and there were myths around the solar power. Those have been exploded one after the another globally, and I'm sure those are being exploded in the Indian context one after the another. By now, more than 22,000 megawatt of the renewable or the solar power, the bids have taken place out of 100,000 megawatts. So that indicates that the achieving that target is not impossible, but well within the reach of the government. What has made it possible is not only the Government of India initiatives in terms of the policy reforms, in terms of the administrative reforms, in terms of the regulatory reforms, but what's important is the healthy competition between the different state governments in attracting the renewables, particularly the solar power. And as a result, we see most of these states, almost all of these states, have a policy for promotion of solar power, for promotion of renewable power, and so on and so forth. This we have to see in the context of also the climate change, the global thrust on the climate change and the climate change policies. Therefore, in the times to come, the emphasis on the renewables is going to increase and is not going to subside. The change that might take place is from the generation projects. It might shift to the rooftop, it might shift to the distributed generation, and the another important aspect of the renewables, or like renewables, which we have ignored in the Indian context for last many decades, is the demand side management. The efficiency in generation, in transmission, in distribution, and in consumption of power. Now that efficiency would lead to a lot of investment and thereby saving in the electricity consumed. So that's the another important development that has taken place. On the stress asset side, some of the significant moves that have taken place, and that for us, financial institutions are going to be of a great help. First and foremost is the thrust of the Reserve Bank of India, the Government of India, that the defaulters, willful defaulters, would not be accepted anymore. They have to fall in line, they have to perform and deliver, or they have to fall in line in the way that the lenders are able to retrieve their money back. And the money which is blocked into the stress assets is brought back into the economic life of the country. It has had a salutary effect on the psychology, on the approach and the behavior of the delinquents borrowers. The another is the last week we have seen the bankruptcy law or the code passed by the parliament. It's going to transform the relationship between the lenders and the borrowers. The third thing, particularly in the context of the PTC, India Financial Services, and the IFCs like us, is the notification of coverage under the Surface I, which is expected any time now. All these things would help the institutions, the bankers, in managing the defaults, in managing the stress assets. In terms of the direction of the investment that is going to take place in the times to come, I've said in the power sector, we are going to see the investment into efficiency improvement measures. We are going to see the retrieval of the investment blocked into the inefficient generating assets of which are 25 years old or which are being run through the inefficient technology. We are going to see the huge investment into the renewables. We are also going to see the renewed emphasis on the transmission and the distribution and the participation of the private sector into transmission and distribution. The investment in the power sector in India have all along been imbalanced. There has been focused on the generations without adequate emphasis on the transmission and distribution. That balance, I would believe, is going to be restored in the times to come. Another area that I see in the context of the infrastructure and which is going to be given impetus in the near future is the last mile funding for the road projects. Our interactions with the NHAI and the Ministry of Transport suggest there are a large number of projects which are held up for the want of last mile funding. The institution like PFS has a great role to perform, has a great opportunity if those projects are annuity-based projects. With the thrust on the infrastructure, there are new opportunities which might arise in terms of the ports, in terms of the infrastructure logistics, and we are seeing great opportunities into those areas. If I see the performance of PFS, which Dr. Pawan Singh would take you through in greater detail, I would like to sum up those in 2-3 major points. One is there has been growth in the nature and the level of performance of PFS. If you look in terms of revenues, be it gross revenues, be it gross interest income, be it a net interest income, profit before tax or profit after tax, there has been jump, there has been growth. All these figures have increased between 25 to 30%. Our profits have increased, profit before tax have been of the order of 525 crore plus. Even if we take it aside, the profit on the sale of equity investment that we have made in Ind-Bharat, our profit this year is more than 325 plus crores, and which records an increase of 32% over the last year. The second important aspect of the performance is the shift trend in the portfolio of PFS. Very silently and very swiftly that we are aiming at, and to some extent we have been able to achieve. In 2008, 7-8, when the entire country was focused on the thermal generations, we saw an opportunity into renewables, and silently and swiftly we shifted our business model to renewables. Now when there is a lot many institutions and the competition, the renewable financing, we are trying to position ourselves into other economic infrastructure. And it's a very calibrated approach. And let me tell you that we are not guided in our growth by the numbers. We are not behind the number game. We are equally conscious of the quality funding. We have grown between the range of 30 to 50% all along. And as we see the investment opportunities in the power sector and the related areas, we believe that should not be difficult for us. But certainly, we are not behind a number that we must reach to X number by the end of this year or X number by the next year. We are certainly conscious that we need growth, we need a satisfactory, healthy growth, and a sustainable growth. And I believe between 30 to 50% growth in the given context of the investment opportunity that the economy and the power sector affords, that should not be a difficult thing. So after the renewables, we shifted to other economic infrastructure, the ports, the roads, the infrastructure logistic, the mining development. And today, in our loan book, in loan sanctions book, we have about 15% of our total sanctions, 10 to 15% of our total sanctions which constitute to this area. This has helped not only in the growth, but also managing the risk profile of the portfolio. As we have seen the thermal in the beginning, and maybe we do not know if what happens if the renewables explodes. So we are trying to balance the portfolio and trying to manage the risk of the concentration in the portfolio to a particular sector. Today, on this account, if we see our gross sanctions, gross effective sanction has exceeded 15,000 crores. Our revenues have exceeded 1,000 crores. Our book has exceeded 9,000 crores. And the growth in the loan book this year has been about 36%. And that has been the pattern that we have followed all along. There are certain areas which all of you are concerned in terms of the stress that we may carry on our balance sheet. We have shared all those figures. Mr. Pawan Singh would share more details on that. But let me tell you that we are in a financing industry. We are in the power sector. We are in a regulated industry. The risk is inherent to our business. And as if many of those who are with us in our first IPO, this was the fact. At that point of time, we are not having any NPA. And I still tell thee that we are in the financial sector, we are in the infrastructure, we are in the power sector. Risk is inherent in our business model. What is important for us? Are we equipped to handle that risk? Are we managing our risk properly? How are we managing that risk? You have the quantum of NPAs, gross NPAs, net NPAs, and what we call is the provisioning against the standard assets before you. We have been dealing with each of the assets. I think that has become one of our major functions apart from the growth. The amount may be small or big, but that has become, that is getting equal priority as any other aspect of the functioning of the company. Maybe 5 or 6 in numbers, but for us, even a single number matters. We are constantly engaged with the promoter. We are constantly engaged with the other stakeholders in the projects, the co-lenders, the regulators, the government, depending upon what kind of the problems that project is facing. And we are seeing some positive signs, some positive movements in those accounts. If there was no financial closure for the overrun, the financial closure for the overrun has taken place. The COD has taken place. And the issues that the promoters were facing, we have been able to work with them and able to solve them. So maybe in the times to come, 6 months or 12 months, maybe those stress assets would be distressed and maybe started functioning productively. Our quality of due diligence remains as strong as it used to be. And when we are dealing with these cases, and we are dealing with those cases in uncertain situations, two things can take place. Those can turn into positives, and those which are at the brink may also turn into stress assets. We have been very conscious of this possibility, and while we deal with those cases, we also try to provide for on a conservative basis, and that has been the hallmark of our policy as far as the provisioning is concerned. In terms of our future profile, our USP lies in our approach, in our positive orientations, in our ability to structure the projects, in our ability to have a niche market, in our ability to move first for grabbing the opportunities. We see, for example, the rooftop, a big opportunity in the next 2-3 years to come. We see distributed generation, a good opportunity to come. We see the last mile funding of the road project, a good opportunity. We see the offshore wind as a good opportunity. We also see, while many of us possibly is not even talking about those small thermal power projects, which the government would take a decision in some time to come, I would believe personally, to close them down and ask them to use for the alternative power projects, or maybe for supercritical, or maybe with power project with supercritical technology. We are also seeing that as an opportunities. And in all these areas, we are trying to move fast. We are trying to move first so that we are able to have a larger share of the market opportunities, and we are able to have a greater yield before the other lenders enter into that arena. So with that, ladies and gentlemen, I'll once again thank you for all of you coming here, and I'm sure your confidence and trust in us would continue to remain as we have enjoyed all through. Thank you very much.
A very warm good afternoon to everybody, and welcome to the Investors Conference of PTC India Financial Services. And in fact, Dr. Haldia, MD and CEO of PFS, has very elaborately given the backdrop of the sector, also about the way business has moved, also about the challenges which we are facing, and also not only challenges of the sector, but he has also talked about the challenges within the company. And he also tried to give a roadmap of how the business strategy would unfold in future. I would like to come to some, our performance for the quarter, and give you the number crunching, which, we have been able to. Some of it is known to you, and some of it, of course, we'll try to give it to you in more detail with a little bit of analysis. This is a slide which we always start with for those who are new, just to give you a snapshot of the growth of the company. It was incorporated in 2006. It's a roadmap of nearly last 10 years, and how the company gradually has grown and taken size, and also acquired reputation in the market, also how it has been globally recognized by international global financial institutions. Then, of course, just again, this is also a slide which we normally, is a part of our standard presentation, where the products which we are handling, we continue to do that. Of course, there has been a flavor added to it, that there are areas which we are looking more closely now. Board of Directors is what by and large used to be there, but some changes have happened. Mr. Nagarajan, who is Director of Finance of Power Finance Corporation, has also joined our board. And then Mr. Ajit Kumar, Director Commercial and Operation of PTC, is also now in our board. And Mrs. Praveen Tripathi, very eminent civil servant and member of Indian Audit and Account Service, who was Deputy Auditor and Comptroller General of India, has also graced our board now. Two of our board members completed their tenure, and they made stellar contribution, and I would like to mention two names who are not there in this presentation. Dr. Desh Kohli, who was ex-chairman PFC, he was in our board. He was with us at the time when the company was really taking off. And Mr. Muralidharan, who was a very senior functionary with IRIDA as well as Reserve Bank of India. While appreciating their contribution and welcoming the new directors, which strengthens the corporate governance further in the company, let me quickly come to the area which really, requires focus and attention. So one is the loan book. If you look at it, the loan book has, grown almost by 55% this year compared to, 40% compared to what it was last year. So this is the kind of growth we have had. And interest income correspondingly also has grown up accordingly, and about 30% growth has been there in the interest income. Profits have jumped up quite a bit, and even the profit without taking the extraordinary income which came out of sale of equity, it has jumped quite a bit. The important thing here is that if you look at the slide at the top, the trend in the borrowing, you find that the color composition by and large has been, number of colors are getting added. So that means we are diversifying our sources of borrowing. And in fact, in 2015, we were able to add commercial paper to our borrowing program. And in 2016, we find that there is another, not gray, but it's somewhat greenish portion of the bar, which demonstrate that we have started taking loan at a very, very competitive rate from the Indian financial institutions. Some of the key indicators, I'll take you through the key indicators. Particularly, if you look at the loan disbursed has gone up also over 40%. Loan asset, I have already mentioned. Loan sanctioned, there has also been a phenomenal growth. Over 50% growth has, or nearly 50% growth has happened. And your yield on the loan assets, you will find that there has been marginal decline for the year as well as during the year. And the principal reason for that has been that you will know that the interest rate generally in economy has been coming down, and we cannot be outside the economy. So whatever is happening in economy, we also have to absorb. So because of that, there is some correction. And also add to that is that we were pioneers, as it has been mentioned earlier, that we were pioneers in renewable energy, and we were one of the few players to be there, but then everybody now is finding lure towards renewable energy. So somewhat competition also has crept in, so we have to be in line with the marketplace. So some correction is on account of the economic situation or the market situation, and some correction is also because of the competition which we are facing, and we are trying to also have the growth which we have been able to demonstrate, because we cannot be at the lower end of the growth story. We have to be at the top end of the growth story. So be at the top of growth story, it is also needed that we are in tune with the market development. On the, while we are rising up to the market situation, our endeavor also has been to bring down our cost of borrowing. So some of which is translated in the cost of borrowing coming down from 9.38 for the year to 9.05, and for the quarter 9.30 to 8.95. Second is the spread, which is again the result of the above two yield as well as the cost of borrowing. So naturally the spread would look in relation to these two parameters, and there has been some marginal correction in the interest spread. And net interest margin, of course, there has been some decline, but not the way the yields have declined. But the reason for that has been that we have been able to deploy our capital little efficiently, and not to miss the fact that we could get the money through the sale of equity, which added to the overall capital of the company. We maintain one of the best cost to income ratio. In fact, FMO, who is the Dutch developmental financial institution, and they have given, recently they have given, subscribed to our bonds, about 25 million, and their team was here for due diligence, and they said that they have traveled across globe, and this type of cost to income ratio nowhere in the world they have found. The capital adequacy, of course, with the growth has to have some correction, but still remains fairly healthy at 21.82. And debt equity ratio goes from 3.56 to 3.93. Our endeavor in future would be to maintain, to have a better leverage on the debt to equity ratio. And that as our assets get commissioned, because many of our assets are under construction, but during this year and next year, a lot of assets would get commissioned. And all those assets which operate for 1 year go into the area of 50% risk weight. So maintaining capital at, at the same level, if I suppose, if I have to translate one-to-one relationship between capital adequacy and debt to equity ratio, so we would be better leveraged in following years to come. Return on net worth is, very impressive, 24.60, but then also we'll have to provide for the sale of equity, and even if we discount that, we would be demonstrating a return on net worth of nearly about 13%. Return on asset on an annualized basis is 4.43, and if I take out the sale of equity, then return on asset would be something like what we were able to demonstrate last year. In fact, reiterating the figures here, you see that interest income has gone up for the quarter by 27%, and for the year end it has gone up by 24%. And profit after tax has gone up by 143%. And if you look at profit before tax, it has gone up by 117%. The total expense also, by and large, we have been able to control, because the total expense only has gone up by 7%. And if you look at interest and financial charges for the quarter, it is only 27%. And interest financial charges, even for the year, the change is roughly about 27%. And whereas the income also has gone up by 27 and 24%. So normally this kind of that one-to-one correlation is rarely demonstrated. So in this quarter we have been able to demonstrate almost one-to-one correlation between the increase in interest income and your interest expense. Normally the interest expense is a little higher than the interest income. But one reason for that is, of course, our ability to bring down the cost of capital and the borrowing cost, and also because of the equity income which we got. Balance sheet now looks more healthier than what it used to look like in past, and our net worth is improved because of the profits which we made this year. And only thing which I'd like to highlight here is that we have been able to make a very good mix of, while to bring down our cost of capital, we have been able to bring a very good mix of short-term and long-term borrowing. You would see a long-term, short-term borrowing figure which is reasonably high, but at no point of time while we do so, it affects our liquidity or asset liability ratio. And RBI, when we give our report every month or every quarter, we ensure that at no point of time we exceed in any of the ALCO parameters which is laid down by the RBI. Of course, one area which you would like to have a greater deliberation and understanding is the provisions which we have made this year, and of course not part of the balance sheet, but I thought I'll cover it up as I was supposed to cover it up in the previous slide. And you will raise this issue of provisioning, but let me tell you, none of this provisioning is on account of a statutory requirement. None of this provisioning is arising out of any mandatory obligation, but the provisioning has been voluntarily done, and the provisioning is arising out of the extra provisioning which we have done on our existing gross NPS, and some provisioning on account of the assets where we voluntarily felt that wherever there is possibility of some stress coming in future, we tried to provide for it in the upfront rather than waiting for the asset to go bad, or so wherever there was some anticipation or some even ray of possibility of that asset going into difficulty, we have taken this opportunity to provide for that. Again, this is a lot of things have been covered in the previous slide, but just to give you a snapshot how the NIMs have moved over the quarters. And NIMs are at 12.82. But if you compare it with the previous quarter, it is almost flat. You will find that the cost of funds in this quarter is slightly higher than what is there in the previous quarter. Now, this I would like to answer is that what happened is that this is the last quarter of the year. And this year, in the month of March, there was typically very tight liquidity. So we had to liquidate all our commercial paper, because commercial paper rate also it was hitting the roof. So we switched the commercial paper to our short-term borrowing. So there is a minor correction which will probably to great extent get corrected in the first quarter of the current year. Then if you look at the NIM and spread, NIMs are also by and large flat, small correction, but then the kind of loan book growth has happened and the market situation. And similarly, the spreads also have corrected over last quarter. But there is the correction, if you look at it, it's almost by and large the graph is still flat. It is a flattish with some dips here and there. It is by and large flat. Debt sanction remains at 15,074 crore, and it has gone up from 10,908 crores in quarter 4 of 2015. So there is a huge jump which has, I was talking about nearly 50% jump which has happened. The best part of the story here is that the jump is so much so in the renewable space. And let me also share with you, among the stress assets, renewable hardly find any space in our asset book. So that is another redeeming factor of this growth. Second thing which has happened is the others, you will find that some growth has happened, which is on the higher side. And thermal, also you will find some growth, small growth which has happened. It's hardly any growth, but is by and large stagnant, but small growth has happened. And, so very, very marginal kind of a growth has happened on the thermal side. If you look at the debt outstanding, of course, because the incremental growth in renewable has happened over last 1 year or last 2 years. So, between the sanction, though sanction would be much higher, it would be close to over 65%. The debt outstanding in renewable is about 50%. But going forward, the sanction and your outstanding figure would narrow down. So you will find that even outstanding, the renewable has a larger space in the whole bucket. In thermal, you will find that if you look at the Q4 of 2015, there is some rise in the outstanding, but that would be, if you compare it with the sanction, because sanction has not grown that much. So it's on account of existing projects where disbursement happened, because thermal projects take long time. Similarly, in others, there has been some incremental growth. But the large part of the growth is coming from your thermal side. Hydro, we have been able to come down. Despite the existing disbursements which are happening, hydro by and large, because wherever possible we have tried to, repayments have happened or prepayments have happened. So we have not really gone aggressively on the hydro side because of the challenges of the sector. So we have been responsive to the business situation and business challenges as they have come. About the equity, since last quarter there is no change in the equity status. We continue to hold India Energy Exchange, 1.52%. East Coast is what we still continue to hold. And RS India is fully provided for, though it's getting reflected in this slide, but then we have fully provided for. But let me tell you that asset is, it's not that the asset is not there. In the ground, almost out of this 99 megawatt, 42 megawatt is up and running, and the land for 99 megawatt is available. But on a conservative basis, and the promoters' inability to bring further equity in the project, we have 100% provided for it. But going forward, there is possibility of recovering a good large portion of this amount. Then this is the slide on the holding as it stands today. PTC continues to hold 60%, NRIs and others 22%, FPI and FI is 10.3%, corporate bonds is mutual funds, and banks and financial institutions. So way forward is always, already we have talked about that. So we'll continue to leverage on our knowledge of the sector, and of course we'll do cherry picking in some other select infrastructure sectors wherever there is scope. We are very, very selective in doing other sectors, very, very choosy and selective. So we'll try to be as choosy and selective there. And of course, our strength, power, renewable, that we'll try to leverage on that. And other income, that is the fee-based income, will be again our focus area in coming times to come. Thank you very much. So we'll have question and answer session. So we'll be happy to take questions. Thank you.
Good evening, sir. This is Hardik Jain. So, if you can give us the breakup of provisions, because I think it is mostly related to Konasima, ICOM, and Surana Power. And if you can give us the outstanding amount of all these three accounts as of today, and what is the amount of our restructured book? And since last couple of quarters, we have been mentioning that we'll be focusing more on projects other than power. So what is the size of that ancillary and other than power book amount of that? And just your opinion, because accelerated depreciation has been removed on wind power. So your opinion on it, how do you see the sector going forward? And since rates of solar, as we are witnessing, are dropping down, so definitely IRRs for those projects must have come down. So what are you seeing on ground for the solar projects in the bidding, and what's your view on it? Thank you.
So we'll in fact try to answer your question. Part of question I'll answer, and part of question I'll request Dr. Haldia to answer that. See, as far as restructured asset goes, as of now, we have, we are talking about, when I talk about restructured asset, I'm talking about standard restructured asset. Yeah. So standard restructured asset in our book is now, as of now, is roughly 439 crores. So out of which we have made a provision of 22 crores there, and we have 417 crores. Now let me also clarify here that when I talk about standard restructured assets, they are the assets which are not the assets, in fact, the RBI had a policy before March 2016, and then it had a policy before, 2015, and policy after March 2015. So there the restructuring used to happen because the asset quality has gone bad. Whereas the standard restructuring norm is where the project, infra project, where the gestation period has been extended beyond 2 years. That means 1 year on account of promoter and 1 account of, unforeseen circumstances, legal and all those things. So it's not that it is, the project has gone bad. And these are all infra projects which are in progress. They are at a very advanced stage of commissioning. But being thermal project and hydro project, a 2-year delay is something which is very not unusual. So that is the kind of provisioning which we have.
This 417 crore is mostly thermal and hydro?
Sorry?
this 417 crore is mostly thermal and hydro.
Almost all.
Yeah.
Yeah, it's
These are only these two.
yeah, only these two.
Now, if I can only add to what the Dr. Singh has said, is that while these are stress assets, I was saying there is a positive movement forward. I'm not saying they have converted the entire cycle, but the positive movement forward. Like in one case, the overrun funding has been tied up. In another case, the project has gone into the COD. It is facing a minor working capital loan related issues. In the third case, the lead lender has put the assets for sale, and there are 9, I've been told last information, the 9 investors have shown interest into that project. So there is a positive movement forward in these cases.
So how many number of accounts would that
It's
be?
4, you said 4?
4.
What is that?
Yeah, it's in fact it's 1, 2, 3, 4, 5.
5 accounts.
What is that? Okay, I can explain the other also. Yeah, in one of the cases, we are expecting that the borrowers might pay the entire outstanding amount. And this is because you might raise many questions in your mind, so let me clarify. It's one of the short-term loan, which was a brisk loan kind of thing. So I know we are dealing comprehensively with these cases. If it requires legal, irrespective of the level and the standing of the promoter, we are not afraid in taking legal actions. We are not afraid in taking the issues with their other stakeholders, with their equity partners. So all these things are showing, the impact.
Yeah, and coming to your other part, same first part question, but another portion of the first part, that the total NPA assets in our book as of now are 293 crores, out of which we have made provision of 93 crores on them. So net outstanding amount is about 200 crore. And if you look at our, in fact, gross NPA to net NPA ratio, it is now 3.40 is gross, and net NPA has come down to 2.35. So against 2.80 last time, it has come down to 2.35.
Okay, so outstanding amount from Konasima, ICOM and Surana Power?
That is net of provisioning.
Yeah.
So net of provisioning outstanding amount for ICOM is 28 crore. For Konasima is 76 crore.
Okay. And Surana Power, sir?
Yeah, Surana is now 84 crore.
Okay. And your opinion on wind and solar, sir?
I'll try to give you some idea, then I'll request Dr. Haldia to give a more elaborate explanation on that. See, one is wind. I don't know why you are saying this accelerated depreciation has been done away with. Our understanding is accelerated depreciation remains. What government was planning to do is to do away with the GBI, generation-based incentive. But yesterday only we were having meeting with Secretary MNRE, and he said that, of course, this is in the 4 wall, we should not quote, that this will probably be extended. So there's no fear on that account. As regard the solar prices are concerned, solar prices, there are a number of ways of looking at the solar prices. One is that the concern that the prices are really falling down. And because of that, whether the loans which are going to such projects, whether they remain to be viable or not. But there are a number of ways, because we have been talking to a lot of international developers, and they say that one reason for solar prices coming down, they feel very comfortable with solar prices coming down, because they say that, for example, China, the solar prices are very high, very, very high. They are much higher than your conventional power. And because they are much higher than the conventional power, they never get paid. Because somebody would buy conventional power, unless you force them to buy normal power, the renewable power, he would not buy that power. So from one angle, falling prices are good, because then they are at grid parity. And all the time we have been talking about having grid parity in wind and solar. Wind had achieved earlier, now solar has achieved. Now, whether these tariffs which are being quoted are viable or not, first of all, let me clarify, before entering the room, I rang up my team and I wanted to know, before this question is raised, as to whether we have funded any project which is at a very, very low tariff. So he said that we have not funded any project so far below 6.5. But there are proposals at 5.5 level plus, which are available with us. So we have not gone and funded the projects which have been highly aggressively bid so far. But even on those projects, if you look at it, the explanation which I gave to you, that is one. Second is that those projects also are happening with a certain backdrop. It's not that we are jumping to fund those projects. We will apply our own due diligence. But they have a certain backdrop. Like, for example, they are mostly projects where the NTPC is buying power, or NVN is buying power, or SECI is buying power. So there is a lot of certainty of payment. Land issues have been tackled. The size is very big. Economics of scale is there. So all the uncertainties of sectors are over. So because of that, they are getting that kind of a price.
The one question that you raised about our exposure to other than the renewables, thermal, as I said, it has been our considered strategy to move away from the power for two reasons. Once as a risk mitigant portfolio, concentration, and the second thing is strategy for the growth, because we were seeing the opportunities there. Since we have taken these decisions, our sanctions to these areas is between 10 to 15% of total sanctions. What kind of project this includes? This includes the transmission, this includes the ports, this includes the energy efficiency, this would include the road, this would include the railway sidings linking the projects to the mines, and also the infrastructure logistic. And as I said, we have a very calibrated approach that we are following. And that calibrated approach means, for example, in the road, we are funding only the annuity-based roads, and where the last mile funding is critical. In ports, we have taken up only those projects which are expansion of major ports or the minor ports. So we know the track record, operational as well as financial of that project. In case of a transmissions, these are the private players whose bids have been accepted. So we are very choosy on the track record of those private players, and also which area, and transmissions projects are like an annuity projects in any case. So that's one area. Let me also tell you that we have to grow while dealing with the situation of uncertainty and the risk that this sector has. As I'm saying, these are inherent risks. So even if I tell you that my business model is risk-free, I'm not telling you the right thing. So it's a risk. We have to grow. So there are other ways we are looking into. There are certain structural initiatives we are exploring. At appropriate time, we would share with you whether it is on our balance sheet, it is outside the balance sheet, but that's those structural initiatives we are looking at. The second question and second thing is within the sector itself, we have to move from one level to the another level. So earlier, there used to be only the solar power projects, 5 megawatt, 10 megawatt. Now you see utility scale 50 megawatt, 100 megawatts. Now it's become a common run-of-the-mill type projects. We are looking at the new opportunities. What are those new opportunities? So we are trying to talk to some of the leading players in the industry. Can we have for the rooftop solar a new structure where we are able to find at the aggregate level rather than every roof? So that is going to our niche area in the times to come. I shared with the distributed generation. As of now, it's a riskier model. But we are working with some of the state governments, some of the players, and we are looking into their model, because as of now, I'm talking to you, there are about hundreds of villages where the distributed power generation is taking place through the solar. And we are looking into those models, and we are seeing how those models can be risk-free. So that would be another niche area. No institution in the country is financing. We were the first to finance rooftop in the state of Maharashtra, Karnataka, and there is no default. And the advantage is all major players are first looking at us, where the bankers are able to perceive the risk PPA risk or the rooftop risk, access risk or the grid risk, we have been able to do. So that's the area of focus would be. The second question that you said about the wind power, you are right. If you look at the numbers, as if the wind power capacity is decimating. But to me, that would be a temporary phenomenon. And first, the reason is very obvious. It's a land base. Most of the land, A-grade land, is already occupied. There are land-related issues. The business model of the wind industry is quite typical, and it's not a market-oriented. You have a EPC supplier who acquires the land. He gives you the plant and equipment. You do not know how much it constitutes land and how much it is plant and machinery. The new generation entrepreneurs coming into the wind industry, they are separating the business model. They are also acquiring the land. They are also going to some other place to the EPC. So they are making the margins more than the conventional business model where they used to be integrated. The wind turbine supplier would acquire the land, do everything else. So that's changes taking place. Second thing is that now the turbine height is about more than 100 meters, 120 meters. There the PLF increases from typical 15-20% to 35-40%. So the reconsolidation would take place. The turbines which were set up in the 90s, 95 or 2000 for tax advantage purposes, I'm sure the pressure of economics and technology would mean that the reconsolidation take place. Those turbines would be replaced by so there a new investment opportunity would come in. Third investment opportunity that we are looking into, good and bad times both offers great opportunities. And I personally believe when there are bad times, that's the best time to strategize and look for a good opportunities. Precisely in the wind industry, consolidation, merger and acquisition is taking place. So the conventional developers who set up 50 megawatts, 10, 20 megawatts, you are seeing now we have developers who are aggregating 500,000 megawatts. They are looking for turbines to acquire. So many of the groups have grown by acquiring the existing players. So there we are seeing the opportunities, acquisition financing. So the wind, you are right in that sense that it may not gallop as the solar is, and that's why the government of India targets is also about 100,000 to around 60,000 solar versus the wind. So that's the answer. As far as the solar power is concerned, I said there are myths around solar power. Those are exploding, and I thought last time I shared with you in 2008 when we had first power project of 4 professional of the world's largest management consulting fund approached us. Our business model said our IRR 6%, their business model said their IRR is 20%. We were not convinced, but we still thought the promoters are good. There is a great potential in this industry. We called a special meeting of risk committee and we said, should we consider 6% IRR or not? And we said, yes, we should, because the lenders are, when there is satisfactory DSCR, debt service coverage ratio, so lenders are safe, they are compromising on their IRR, so let's go ahead with it. We did that project, and you see the situation today. I have occasion to speak to all these multinationals who are quoting 425, 432, 454, whatever. I had occasion to look into personally talking to some persons in Dubai about the latest bid where the solar power, their 3 cents, that is 1 rupees 80 paisa per unit. When we bid, we have certain strategy at the back of our mind. We have certain business plan before us. And within that context, and we have our own economics. Within that context, we take a decision how much to bid and what price to bid. So my bid might have a different perspective and your bid might have a different perspective. You have a Central Hotel here, was bid and somebody bought it and everyone was laughing at him. And within few months and few years, he made a huge profits. So everyone his own perspective, and occasion to speak to all of them. So their factor is that if I take 2 minutes, because that's again myths, which, they have a different perspective. They say, look, we are going to a solar park. There is no implementation risk. It's an heavy NVV and supported project, so there is no counterparty risk. Transmission lines are there. We are a world's global player. Even one of them seems to have, going for a restructuring of his debt. But we are a global company. Globally, we have a capacity of 500 megawatt to bring in. We can negotiate with the plant suppliers for a reduced price. We can have a EPC at a lower price. And at the end, he also added that I am compromising at my IRR. CRC allows me 15%. I feel I am to enter into India. I to enter India with a big bang, with the future prospects. I am content with IRR of 11%. So that's what his call. Now somebody like you and me may think, no, I will not go beyond below 20%. So for that, it would become uneconomical. When they approached us, I said that if you're looking finance from us, you'll have to give me a firm EPC contract, firm suppliers contract. You will also give me as to how your equity is firmed up. And if you are saying that you would part of your debt would be firmed offshore, you'll have to give me sanction letter. If I'm sure on all of these, and then I come to that you would still make 11% IRR at 4 rupees 24 paisa, then I'll lend you. If any tentativeness in any of these elements, then I'm sorry, we are not going to provide you support. So we have to look in that perspective. So 4 rupees can be very bad for me, 4 rupees can be very good for you. So that's all depends. But if we look into the prices would, to me, might fall further. The capex would come down. There is some problem because of some issues in the China, the price may firm up for another 6 to 12 months. But long term, the prices would come down. Long term, because of the climate change thrust, the global thrust would be on the renewables and these kinds of. So I would see the rates of the solar as a lender to me, 6 rupees or 10 rupees is as good, as bad as a 4 rupees would be. I have to see every project on the basis of the risk that is exposed to and to what extent those risks have been mitigated.
Can you give a breakup of your gross NPL in terms of renewables versus thermal, or is it all thermal at this point of time? Question number 2, if you could give breakup of your loans in renewables in terms of solar and wind, and in terms of thermal in gas and coal. And third question is, in your outstandings, you have a slide on sanctions till date. What are the outstanding sanctions yet to be disbursed at this point of time?
Coming to your first question, that is on the of my NPA, what portion is what? So let me tell you of my entire NPA which I have, that is about 200 crores. In fact, out of this 150 crore plus is about 160 crore is on account of thermal, and balance 40 crore, 28 crore is an EPC company, and a very small portion is renewable, about 11 crores. So, and that also is not because of problem with the project per se, but it was in Tamil Nadu and there were evacuation issues, so because of that. Now this project is up and running and it started also doing its debt servicing. Coming to your question on the loan book outstanding, in fact, if you look at our loan book outstanding as of now, you will find that of 15,700 crore which we have, renewable is of the sanction is roughly about 50%, nearly close to 50.
I want of the outstanding loan book, which is about 7,000.
Yeah, out of the
8,600 crores.
That also we have explained there in the presentation. We have said that the total outstanding 8634 crore, 37840 is renewable.
So out of 3780, can you break it up between solar and wind?
As on date, it would be almost same.
50-50.
50-50.
And
but solar would take precedence over wind in coming times.
Maybe a couple of percentage point here and there.
Yeah.
And in thermal, which is 2594 crores, how much would be gas and how much would be coal?
Gas is only one which has become an NPA, which I mentioned just now.
Okay.
That is as on date, it's 76 crore outstanding.
Okay. And out of this total cumulative sanctions of 15,074 crores, how much would be there yet to be disbursed? This is cumulative till date, right?
Yes, yes, yes.
Out of that, how much is yet to be, disbursed?
What is not disbursed is, what is not outstanding. What is outstanding has been disbursed.
No, but
You're talking about the other.
Yeah, so let's say, there is a project for which financial closure has been done, but loans are yet to be disbursed. We have sanctioned it, but not disbursed yet.
should I?
Yeah.
It's about 4,000 crores.
Okay.
And the board meeting that we had last week, we had sanctioned another about 1,600 crores projects. So the pipeline would be, which is a sanctioned pipeline as of now, would be about 5,000 crores.
Okay, okay. And in one of your opening remarks, you mentioned that, there are, the credit risk weight would fall once, many of these projects become operational. So within, let's say, thermal and, within renewable, what would be the proportion of operational to, sort of under construction projects for our outstanding loan book? Even on overall basis would do, I mean, out of the 8,000 crores.
Today overall about 60% is operational.
Okay.
Right.
Okay. Okay.
Okay. And in case of thermal, the ratio could be about 30-70. 30 would be operational, 70 would become operational.
Now, in context of, looking at your operational versus non-operational loan book, our loan book at the end of the year was roughly about, 8,600 crores. The disbursements were roughly about 3,550 crores. So, repayment could have been roughly in this year, roughly about 1,300 odd crores, right? So, opening loan book plus disbursement minus repayments, closing loan book. So the balance figure of repayment would be roughly about 1,300 odd crores. Would that be the right number?
Your perfect calculation, 1279.
Right. So that as a percentage of your opening loan book is as high as about 20%. And which implies that there is a 5-year repayment period, implied on the loan. Now, if you look at some of the other infrastructure financing companies, usually repayment is not more than probably a single digit number or up to, let's say, about 13-14%, a fairly long gestation period loan. So how can you explain this difference of, fairly high repayment rates in your case versus?
I'll give the breakup of this 1279. That would answer your question to not full extent, but a large extent. Out of this 1279, repayments were only 189. So that takes care of your latter part of the observation which you made. And prepayments were 767. And we did downselling of 128 crores. And we recalled loans of 195 crores.
Sorry, downselling?
Downselling was 128 crores.
And recall?
Recall we did 195.
And the ones who are sort of prepaying, would they have got somebody else, to fund them at lower rate? Would that be the reason, or what could be the reason of prepaying? Or let's say promoter got their own funding.
This would be two reasons. One is, yes, one is very obvious. There is somebody who is refinancing it. The second reason is that the restructuring is taking place. They have number of SPVs. They have shifted all those SPVs to the holding company, and the holding company is then going to one particular bank to get it refinanced. The second thing is that in most of the cases there we have these prepayment have taken place. It has released our exposure norms for those groups, and we are able to fund them extra. The third thing is, let me preempt your question, is that this refinancing is taking place because of the lower interest rate offered by some of the banks. I would not say established, the larger banks, maybe the smaller banks. And also some of the terms and conditions they have relaxed. So we take a very balanced call. What is the track record of the promoter? Why he is prepaying? If he is prepaying for the larger issue of restructuring and the cash flow securitization, that's his strategic call. And obviously we cannot and we should not come in his way. But say for example, in couple of situations, the bankers have relaxed the requirement of debt service coverage ratio, that they would not require debt service coverage ratio from these promoters. So we said that we will not relax this condition. So it's better that they prepay. And obviously they have to pay the prepayment charges.
Sir, one question on technology, if you could help. The need for renewable is without doubt. So going forward, the increasing the plant load factor with some technological developments, if you could give us some idea as to what's happening globally and what could we see in solar particularly going forward?
Two major changes, those are going to take place. In fact, if we track through the laboratory research taking place globally, and some of them put into commercial testing, a very small scale. One is that the PLF, what we see today, 15, 18%, in next 5-year time should go to 40, 45% because of the change in the technology, the component that is used in the cells. That's the one thing that's going to take place. The second thing going to take place is the battery. So today, the battery storage, if we use that, then our cost would be about 20 rupees per unit. The lithium and the other material, those are being used. With that, the cost of the storage is going to come down to as low as 5 rupees, 4 rupees per unit. That taking place, that would totally revolutionize the solar sector. Now let me answer the second question also, I mean without your asking. Then what happens to the existing projects? Now the answer is very obvious. One is that they are having a PPAs with the sovereign governments. Now they are expected to honor. But the question could be that we know how the government behaves. But I am sure in India, till they would require to demonstrate confidence into the investors, they would not do anything in reneging the contract terms and conditions. Like what sought to be achieved in Gujarat, ultimately the regulators say, no, you cannot reduce the rates once you have agreed to. That's one thing. Second thing is, what is this total we are talking about? As of now, we have 6,000 megawatt of solar. Now we are talking about 175,000 gigawatt of this renewables. So it's very minuscule, or 100,000 megawatt of the solar. So 4,000 is very meager. And if gradually this comes over the next 4 to 5 years, then this would not be a very significant capacity which would burden the overall cost of supply in the entire power sector context. But yes, not only the solar technology might change, there may be new sources of energy would come. You know, there are laboratory going on, tests going on, the heat temperature within the room and outside the room. You condense it and use for generating the electricity. Now those are the new developments taking place. So the energy so far, power sector so far, as we used to say, the 100 years, the same technology, the same turbine, the same boiler, the same thing used to take place till 2000. After 2000, there has been very fast and quick changes in the technology, and I'm sure those would be still faster in the times to come.
So, sir, assuming the technology that you're talking about does see the commercialization in, say, about 4 or 5 years, would it be fair to assume that cost of solar installation would further reduce from that 5-6 crores that people are talking per megawatt to even lower?
It would two ways. Cost can reduce, or the generation cost per unit can reduce. While the capex might remain with the PLF increasing from 16-18% to 30-35%, the cost of generation per unit would reduce. Yes, that might.
And sir, one final question.
Yes.
Could you throw some light on the rooftop solar that you were talking as the way forward?
Right. You know, if you look into the Europe and the USA, for example, often we say that we follow them earlier at the time lag of 10 years, now at a time lag of 3 to 4 years. In the cities, you will find the entire roofs covered by these panels, rooftop panels. The point is that you generate the power on the roof, you consume it, or you consume and the excess you give it to the grid, or you give it to the grid and you consume from the grid. So there are various models available. Now how this can be made possible and practical? What kind of business model have emerged throughout the world? One is that I have a roof, the government has given the incentives, now I believe there is 30% subsidy. So if I want on my roof, I can set a panel and get the 30% subsidy. But that's not economic model, that's not the model we as a financial institution would like to be part of it. Model is the aggregate model, where a developer for a particular area takes the responsibility, talks to the residents, set up the rooftop on their roof, and then maintain them, invest into them, and then supply power to those residents at a concessional rate, or the entire power goes to the grid and they are paid for that power supplied, and then they consume power from the grid. That is the second model. So it could be lease model, it could be capex model, it could be mix of both the models. But it's going to this is the residential. But you see the commercial complexes, huge potential available. You see today's papers carrying the largest ever rooftop project in the Punjab getting inaugurated today. So the commercial complexes has the huge potentials. And we have funded the rooftop at the commercial complexes. So I would presume if I'm living in one part of Delhi, and I would presume the Resident Welfare Association of that would come someday and say, look, we want to set up cover all roofs by the rooftop. You need not bother. You're not required to pay anything. You would rather you will get electricity at a concessional rate, or you would get the electricity free, a certain portion of electricity. I said, why should not be part of that? But you can again ask, if I am a high income bracket, very little motivation for me to save 1,000 rupees on my electricity bill. But there are many environmental and social concerns which a person like me or person like you would be inclined to follow that approach. Yes.
Yeah. Basically, I wanted to know how has the interest rates trended? How is there a decline, and what was the tenor of the loan? What was the tenor then, let's say 1 year back, and what's it now? And how have the terms evolved?
See, the economics is very simple. If the rates are coming down, you have two ways how the rates would come. The capex cost. How do you match the bid rates coming down? Capex cost or the interest cost? There is nothing third element, significant element.
I was asking about the interest.
Yeah, I'm coming to say. So the second important element is the interest. So what the promoter would do, he would in order to make the IRR satisfactory IRR, he would attack the interest rates. So he would look the buyer's credit, he would look the letter of comforts, he would look the foreign funding, right? And then he would attack the interest rates. So interest rates have come down, something from 13-14% to today around 11%.
And the tenor?
Tenor, again, the second thing is that in order to improve IRR, you need to increase the tenor, or you have to change the pattern of the repayments, backloaded. So tenor have gone to 17 and 18 years. And that's not a problem because PPAs are for 25 years.
So what was it before, 17 to 18 years?
No, earlier 12, 13 years even to start with. And there was no problem because the tariff was based on that model only.
Sure. And the second question is, in your opening remarks you mentioned that for the thermal projects, you have seen certain improvements and stranded projects have started moving. Could you give some examples, probably without naming them, that where you have seen projects actually take off? Because there is a refrain in the market that the government's doing nothing, the reforms that the government's taking is not yielding any results. So giving them concrete examples will help.
See, we have to see the entire value chain. First, from development to the implementation, to the operations, to the satisfactory, to the stabilizations. There are four, in the project life cycle. Now when I'm saying, there are problems. When I'm saying project which were stuck about the implementation stage, the lenders coming forward, at least for the project which are under the advanced stage of implementations, the lenders putting pressure on the promoters to go for the SDR, to make the way for the new investors. The lender putting those projects for sale. That's a positive indications. The projects which were in the advanced stage of implementation not having the coal linkages, government tried to give them the coal linkages. Now, your question of the projects which are commissioned or about to be commissioned, they have a problem. They have a problem because they're not able to sell power. There's a transmission problem. There is a problem on the PPAs are not there. Exchange rates, the rates are lower. There are problems. But then, I would believe, I'm not hoping against the hope, but once the Udaya to some extent bring some change, I'm not saying the total turnaround, some change, I would believe the procurement would increase. The last month's procurement level of the DISCOMs shows that increase. So the procurement would increase, maybe they would go for the longer PPAs or maybe the short-term or medium-term PPA, maybe the government would allow coal linkages for the medium-term PPAs. So your answer to your question is yes and no. There are some positive signs, there are some problems remains, and we have to wait and watch.
Sure. Thanks a lot for taking my questions.
So can you just...
Good evening, sir. So first question on provisioning. So 43 crore this quarter is fairly a large number. So just wanted to understand going ahead, I mean, do we expect to see this kind of numbers? I mean, how do we decide when to provide for, standard assets? Because I mean, I'm asking this because this is a fairly big number. The second question is on the capital raising plan that you have shared. So 750 crore is again, I mean, it's a fairly big number compared to the market cap. So is there any timeline or anything that you can let us know, and specifically when our capital adequacy is still at like 21%. Okay, and the final one is on your lending your loans to SPV and on a holdco level, what could be the percentage breakup?
Yeah. So I'll answer your third question first. Actually, the SPV holdco is roughly about 10% as of now, about 10% of the total lending book.
So SPV is 10%?
Not SPV, at the holdco is
Holdco is 10%, okay.
Other things are all SPV because all project finance. So project finance is, large portion of this is into project finance, which is SPV designed. So I'm talking about holdco SPV, not SPV, project SPV. Coming to your provisioning thing, we made this provisioning, well, when you look at the provisioning, we have to go into the, the type of provisioning which we have done, the qualitative part of it, and then we can talk some conclusion from it. So number one is that one portion of the provisioning is arising out of the provision on standard assets, which we do. We do 0.50 against the statutory norm of 0.35, and from this year 0.40. So we do additional provisioning. So because of that, the number is a little higher than what normally it would have been. Second thing is that, we did some voluntary provisioning which we could have, avoided not doing it in the present quarter. But we felt that one is that the assets which have already become NPA, for example, Kona, Sima and ICOM, already we have a provision. So we felt that till these projects become operational and start giving us revenue, it is better that we make additional provision for them. And in case of Kona, in case of ICOM, what we had done is that we have done the value, because we had a security on the land, and we got the valuation of the land. So difference between the land price and whatever the price has come, we have entire amount we have provided for. So only that sale price of the land has been, even in that also we have taken a most conservative, that is the distress sale value, and then we have provided for. In Kona Sima, the project has been allocated gas and they have not been able to operate. So we felt that operations still have not started. It looks like next month it will happen, next month it will happen, but it has not happened. So we felt that more provisioning needs to be done, and that's why we provided for it voluntarily. And there are other 2-3 assets where we made provisioning because we felt that there were difficulties in execution in these 2-3 assets. For example, in Kohinoor, we have made provisioning. Kohinoor, the project was delayed. Already we had made 5% provisioning on account of standard restructuring. Now we felt that since the project would be further delayed, it would be better to provide for additional amount, and that's how we provided for in Kohinoor. In another project which is there, which is called Rajpura, where we have made provisioning, there also, again, the project is 75-80% complete, but the promoter is having some problem in getting last mile financing. We are trying to work around with the promoter so that we are able to complete the project. But till that is completed and it is made operational, the project is standstill for 7 or 8 months, and we are trying to find a solution. We felt that it would be prudent for us to make that provisioning. There have been reasons behind each provisioning which we have done.
So what kind of provision?
But let me also take your questions, which is a difficult part of it, where I thought I must respond, where you said how you would be sure that when it takes place and how it takes place in terms of, and I gave that indication in my opening remarks that we are dealing with the cases. We are dealing with those cases in the uncertain times. There are two things, uncertainty and the risks. Risk you can foresee, risk you can mitigate. Uncertainties you can only guess about, and you can only prepare in a larger and the broader terms. So we are dealing with these cases, and we are hopeful of getting them through, but we are dealing in the uncertain times. And in uncertain times, we may be able to convert them into, continue to remain them in a standard assets, or they might convert into stress assets. So we look at our portfolio from that perspective from time to time, and if required, then we will make then we make what we call it as a provisioning, and that's a healthy sign. So the question is that how and when it takes place. I would only say that we are sharing with you what is our approach, and will not provide for unless we are simply to create a hidden reserve, what we call in accountancy sense that there may not be any forcing problem in the future, but we are still providing for, or will not hesitate if there is an asset where we need to provide for, will not hesitate in providing for that asset. So what I will say is that we are engaged with each of the assets and each of the promoters, and as on date we thought that this could be a possible scenario. As I shared with you, there are positive developments in some of them. Some of the assets, I would not like to sound positive, particularly at the analyst meets, but there could be some of the assets which might take some shape, some of the stressed or the NPA assets which might take shape one or other way in the year to come, and maybe that might have impact on the provision that we have already made. So that's how we have to deal with those situations in a continuous manner, in a challenging manner. So I would only say that it would be more prudent basis that we would be making provisioning.
Sir, what kind of provision coverage that we have now after providing for these assets?
Sorry,
what kind of provision coverage we have right now after providing for these assets?
Yeah, NPOs.
So, see, we have the gross NPA, as I told, is now 3.40, and net NPA today stands at 2.35. So,
and let me tell you that when Mr. Singh is talking about gross and net, we have the collaterals, the significant collaterals that we have in those assets that we are not taking into account, which is available to us, which is not available to other lenders.
And so final the capital raising plans.
Well, see, any financial institution, the capital is the feedstock for its growth and development. So financial raising, capital raising, even if we are at 21.8%, the kind of growth we have demonstrated in past, capital would be a requirement. It could be a question of today or tomorrow. So anytime we would be needing capital. Now, what we have done is we have taken an enabling provision, and enabling provision enables us to engage with various stakeholders and to talk to them about capital raising. So it's an enabling provision, timing, when it will happen, how much it will happen, within that whatever limitation has been set. It is a future thing. But while we do that, we'll keep into consideration the market condition. We'll also keep into consideration the existing shareholders' interest. And we'll also keep into consideration the future growth. Also, we have to keep into consideration, because what is very important is, one is the capital adequacy, but also very important, more than the capital adequacy, is the limitation of our ability to lend to each borrower, each lender. Now we are into a renewable space. Now in renewable space, what has happened? Many of the developers, we were the first one to kind of give lending to them and make them stand. But today, we can only do 25% of our net worth in a single project, 40% of our net worth as a group as a whole. So we have already reached that saturation limit. So time is coming, today or tomorrow. One is from the capital adequacy angle, but also from the angle of losing business opportunities. We would need to have capital in our balance sheet. But the timing, the interest of the existing shareholders, all that will be borne in mind while we take a call.
Thank you, sir.
But I would only add that it's not difficult to visualize the pace we are growing and the capital. They're all public figures, are in public domain. So it's obvious that in order to maintain the capital adequacy, we need the funding. And second thing, what Mr. Pawan Singh said, that if we need to grow, and if the existing balance sheets poses some limitations in terms of the exposure because of the RBI norms, then we have to find alternative ways to grow. That also needs the capital. And any good company has to be fair and just to all the stakeholders. So it's not the question of existing shareholder, new stakeholders. I mean that's I would believe for a management like us is well implied and understood.
Good evening, sir.
So this is a
question from my side.
This is the last, second last question. Please.
So first question, can you just provide some update on the Surana Power, sorry.
See, Surana Power, actually it's a thermal power plant, as all of you know, and in fact it was on a very advanced stage of construction. Only thing is that the developer was not able to bring his portion of the equity because sizable cost overrun had happened. Now, since the developer has not been able to bring his portion of the cost of overrun, the Axis Bank, who is the lead bank in this, they have taken the initiative and they have taken the control over the project now. Now what they are trying to do is that they are trying to have the assessment of the valuation of the plant done. BHL is the main plant and equipment supplier here. However, BHL, because some of its portion of the supplies which they have made, for which the payments are awaited, BHL is not allowing, because it is under custody of BHL. So BHL is not allowing them to do the valuation of that portion. So which people are now engaging BHL, and also the state government is trying to help to have this portion resolved. After this, we'll try to have a buyer for this particular plant. Already we are engaged with a lot of agencies, including the state government power company which is adjoining power plant. They have shown some interest in taking over this project. So we are in the process of finalizing the takeover, and quite hopeful and optimistic, but this teething problem needs to be resolved before that.
Second thing on the Konasima, so I mean they got the gas allocation in the first round, and second round they didn't got it. So now going forward for FY17, what would be your strategy like? Will you have to take a major hit in the Konasima because the plant has been not operational quite long time now?
See, Konasima, we have already made substantial provision. We have large portion we have provided for in case of Konasima. But one thing is very definite, that this plant is not going to be stranded forever. In fact, in the phase 1, see, there was 6 months period for gas allocation in the pool pricing mechanism. In the phase 1, they did not get the gas because they bid on the higher side. Second phase, they got the gas, but when they got the gas, they could not take care of the logistics. One is that they had to arrange certain guarantees, so that guarantees took certain time. also what happened, by the time they got the guarantees, the gas had to be arranged in a swapping mechanism. Swapping mechanism means the gas which was flowing, because this plant is in KG basin. So the gas which was flowing from KG basin to the west coast, that gas was to go there. And the imported gas which is coming on the west coast was to go to certain fertilizer plants. But that logistic, because of there was flow which related to certain taxation issues, because on this gas the local state government also had to be paid certain tax, and municipal corporations also had to be paid tax. So these issues certainly cropped up. Nobody knew about these issues. The government had given the pricing formula mechanism, but then it said that it would be on a swapping basis. That also got implemented. When this implemented the swapping mechanism, this problem now cropped up. Now in the recent budget, they have tried to address the issue of, the taxation. So probably this also will get resolved. So in the third phase now, the bidding has happened. These people also have bid. The good part of that news, the third stage bidding, is that in earlier the subsidy was to come from the government. They had to get certain tariff. In the third phase, when the bidding has happened, they have quoted for negative subsidy. They don't want any subsidy from the government. So by itself, the tariff is making because the gas prices have, because now the price at which it will be available to them will be, at a price which will be viable for them at that particular tariff. So they don't have to take government budgetary support. So it has reached the parity level of. Now issue is that when they get the third phase, and with this taxation thing being resolved, hopefully they should be able to start operation in the third phase. But it can never happen that the operations would not happen. Internationally also the gas prices have fallen down. They are at the level at which imported gas is now available at what the KG basin is supplying the gas. Unfortunately, we have not built up that kind of conversion facility from our LNG point of view. So that is why we are not able to use the entire gas. So it may not happen that these plants will not run. Since they have been closed for so many 2-3 years, that all these problems are now cropping up. But each problem is being now sorted out. Hopefully it may take little time, but the plants would operate.
Thank you.
Sir, you mentioned that around 70% of thermal projects are under construction, which you have funded, right? Hello?
Yeah, please.
Yeah, so sir, my question was, out of this 70%, are there any projects which have already passed their commencement date and which have not been provided? Because RBI allows you to, to have the 2 years leeway. After that, you have to provide for the assets.
Yeah.
And similarly in other sectors like not renewals or hydro or ports, logistics.
Actually, we had tried to give answer to this question in response to another question. We had tried to give answer to this particular question. So, wherever the project is delayed beyond 2 years, 1 year on account of reasons beyond the control of developer, and 1 year on account of court case, the asset can be restructured and it would be considered standard, and 5% provisioning is allowed. Now in our case, as I had mentioned the list earlier also, there are 2 projects falling in this category. In the thermal side, I am talking about only thermal, and that is RKM and Kohinoor. There are 2 projects which are falling in this category. So as far as RKM is concerned, there are 2 phases to RKM. One phase is already complete, and second phase should be complete in next about 6 months. So, and as far as we are concerned, we have made whatever required provisioning is required as per the RBI norm, that is 5%. As regards Kohinoor, we have made 5% provisioning. The project is delayed. It will take 1 more year to get completed. So that is the reason, the earlier question which was asked as to why we have made extra provisioning, that is why we have gone ahead and made 10% additional provisioning. It's not that the project has become unviable, project is still viable, but the commissioning date may maybe get extended by another 1 year or so.
And sir, what would be the approximate outstanding on these 2 projects?
This is, RKM is roughly about 140 crores and Kohinoor is 50 crore.
But the RKM 1 unit is already commenced operations. RKM 1 unit has already started operations.
Okay. And what about sir, other sectors? Are there any such
No,
cases
In renewable, only we have one case of, there's no case of restructuring. only one case of NPA, and that is amount is only 13 crores, and that was because of specific problem of evacuation in Tamil Nadu. And they are also now started doing the debt servicing. So after 12 months, as and when they complete 12 months, it will become a standard asset.
Thanks, sir.
Thank you very much.
Thank you, everyone. Please join for tea and coffee.
Please, I mean, we will answer your question.
Last question we will take.
Yeah, please. Yeah, you had some question? Please.
Sir, your long-term borrowings is 4,843 crores. That is from any institutions or and then your long-term finance is also 7,830. Whether it is back-to-back finance?
The long-term borrowing which we have done comprises of mainly three elements. The bank loans constitute almost 75% of the long-term loans. Then followed by that we have taken an institutional loan, roughly about 500 crores.
No, but what security you give to them?
The security is again on the receivables of the
Projects which you have taken.
projects which we are funding.
So back-to-back, no?
It is back to back.
Securities is back-to-back.
Back to back, yes.
Thank you very much. And if you have any question, please write to Gaurav. Yeah, thank you. And we will write to respond to every question unless we are prohibited by SEBI guidelines. Rest assured.